Hey everyone, Dominic here. 2020 was quite a year, and since I've just started launching videos, I thought it would be a great time to do a performance update. As you'll see in a moment, 2020 was the best year that I've had investing personally. The 48% return that we're about to profile was more than double that of the S&P 500, which is probably the closest mirror of a benchmark to any index that's out there for my particular investing style. As you'll see in a moment as well, not all of the accounts that I manage are managed to be super aggressive, so I think it'll be really interesting to see what the various aspects of how I achieved this 48% return were. Timing definitely accounted for part of it, but I think it would be really helpful for us to go through the positions one by one in detail. Here we go.
Here's how we did this year. Just a quick note, this performance that you see on screen is from February 1st of 2020 through February 5th, 2021, just looking at a trailing 1 year return. We did 48.2% return this year. That is by far the best I've ever done. And we're going to be exploring some of the reasons why I was able to do that this year. So looking at the performance history over the course of the year, you see quite a bit of red over there in the front. And that's pretty understandable. Just in the end of the first quarter, kind of around February into March, you had the full force of the pandemic-related stress in the markets. So that just caused a lot of things to go down at the same time. And you'll see shortly, that's when we made most of our moves this year that really contributed to success throughout the rest of the portfolio. Vanguard doesn't really let you see your allocation too well in this view, so we're going to go look at it a slightly different way.
Here's the portfolio. As you can see, it's organized into 4 different accounts, with the majority of the assets, about 80%, in the discretionary stocks account. That's where I do most of my trading activity and analysis, and it's generally where the most interesting things happen. 2 more accounts are IRAs from retirement assets, and then the final one is a quantitative strategy that I designed in business school. We can go into that one much more detail in a later video, but for now, it's helpful to think of it as one position. Turning to the IRA holdings, as you can see, they're invested relatively simply, mostly in index funds, with a little bit in a couple different holdings. I've got some Royal Dutch Shell in there where I was trying to time it for the yield. Basically, they had a very big dividend, and there's tax advantages to receiving income in IRAs because the taxes are deferred. So that ended up being a very bad trade, but we won't go into that in too much detail here. Turning to the discretionary stocks account, you're going to see 3 major themes here. 1, no bonds. In a world of 0 interest rates, bonds are paying you pretty much nothing, and if you have any meaningful allocation towards them, you're just unlikely to realize a big return in any 1 year. That doesn't mean they're bad for you necessarily, depending on your individual situation, but if you're trying to boost the return of a portfolio, bonds are really just not going to help you at all in this environment. Second theme, you have to let your winners run. So you're going to notice a number of very concentrated positions in this account. That's really more of a result of me holding those positions for long periods of time so they can compound and compound year after year. Basically, the theme here is when you find a stock that's performing well or a company that's performing well, and you know the management team has just got it, just don't mess with what's not broken. Let them keep working for you year after year so that you continue to realize those gains, and several years down the line, it tends to pay off big, and 2020 was one of those years. Third theme is you have to acknowledge the role of timing. Timing can be good and timing can be bad. This year, timing was very good for us. I'll show you why shortly. There was a lot of activity in March and April when the markets were at rock bottom and just starting to recover. So we were able to move pretty aggressively then, and it really paid off in big ways towards the end of the year. Highlighting a couple of the major positions, the one that jumps out is Etsy. This one is 17% of my total assets, and it's because I bought it several years ago, and it's just performed amazingly year after year. 2020 was no exception. I think Etsy tripled during 2020. And the only reason I was able to realize such a big gain from it was because I had been building up a position for several years before that. And then 2020 was just the year where everything kind of came together for them. Another one is Apple, also a very big percentage. Amazon, also a very big percentage. The story is pretty well known as to why these companies are doing well, so we won't dwell on it too much here, but same theme is at play. You find a company that's doing very well, they do very well year after year, don't fix what's not broken, let it compound, and you're going to be very happy that you did. Another one is Smile Direct Club. This is one that I've been watching for a couple years at this point, really ever since they went public. I thought the financial characteristics looked really good. I still think they look good, but this one has had a little bit of an up and down time during the last couple years. 2020 ended up being okay for it. It wasn't a huge contributor to our overall return, but the fact that we invested quite a bit in it a couple of years ago is helping us. Another one that's really interesting that's a little bit more recent is a couple of the real estate plays. So Starwood Property Trust and Simon Property Group are both real estate investment trusts. They own malls and hotels respectively, and they pay out the income that they receive from the rents to the investors, that would be us. So these have done extremely well lately. These are pandemic recovery plays. I was able to notice that these two stocks had not kept pace with the overall market on the way up in recovery from the pandemic in the second half of the year. So I was able to step in and buy quite a big position. And it's really paid off. My thesis there was just that when the pandemic's over, there's just going to be a ton of demand for the real estate that these two companies own. Another two companies that I think of really as one are Walmart and Target. These are both, of course, big box retailers. We all know how they make money and why they do well, but during the pandemic, there's just been enormous demand for the types of products that they tend to sell. Staples, everyday sorts of stuff, groceries, everyone's at home. And the fact that these two companies have really been able to execute online a lot better than they previously have has just contributed to their enormous outperformance during the year. So these are about 5% of the total assets, and they really contributed very strongly to our return during the year. I think it's important to also note some of the stocks that we sold during the year. I don't actually think they're all bad necessarily, but a lot of them had run up quite a bit from pandemic-related tailwinds, and I just didn't see them performing in the same way going forward. Good examples of that: McDonald's, Constellation Brands, Verizon, Intel. I just didn't think it was doing that well. Allstate, another one that just the money is probably better used elsewhere. One I'm disappointed about is Dunkin' Brands. They ended up getting bought out. I was very disappointed by that because I wanted to put more dollars towards it. So we realized about 100% during the year, but it was on a small position, so it didn't make too much of an impact. Going forward from here, how can we replicate a return like this? Short answer, it's going to be very tough because a lot of the stocks in this portfolio have done extremely well as a result of pandemic-related tailwinds. The only way we could really replicate a performance like this in the typical investing sort of way without using leverage or derivatives and stuff is if you get another big correction in the stock market, 10% or more at some point during the year, and we're able to build up enough cash to take advantage of it. So how much cash should we be holding? As you can see in this screenshot, I actually don't carry a lot at the moment. I'm working on building that back up. The more subtle answer is you should have enough cash on hand to deploy into opportunities that you think are going to come up, and you should have enough that doing so is going to make a difference. It doesn't do us any good if we put 1% of our cash into a great opportunity if it goes up 100% and becomes 2% of the portfolio. It's just not a big win. So you want to be able to put kind of more than 5% to work at any one time. So since markets are up towards an all-time high right now, I'm looking to sell out of potential positions. As you see, I sold out of several recently, and probably going to keep an eye on some of the smaller ones there that are just, even if they do really well, it's not going to make or break our performance for the year. But I will be sure to update you guys as I go forward. I hope you enjoyed this video. If you have any questions on anything we just covered, or if there's any topics you would like to see covered in the future, please let me know in the comments. And until next time, see ya.